Hi guys, a very good morning to all our viewers who've tuned into this live broadcast here on Money Control. You're watching Opening Bell with me, Stacy Pereira, and I'm here to take you through all the cues that you need to be watching out for, things that could impact your trading day. And in a volatile market like what we are sitting in and what we are seeing, this is going to be quite important to know how one should really be navigating through these times. But let me just get straight to what the setup is really looking like. And well, we could say that the bears are completely in control right now, at least that pull down that we saw in the benchmarks yesterday, and the Gift Nifty indicating that this negative start is going to prolong into today as well for the Indian equities. Now, we did see the markets witnessing that biggest single day decline in the last 19 months, and that transpired yesterday, which was led mostly by HDFC Bank after their dismal Q3 numbers. And in fact, the ADR2, which is the American depository, that one also has plummeted for the second day now after those earnings, losing about 7.5% again through trade. So whether that could further go into the stocks today is something that we'll have to wait and see. But across the globe too, if you look at Wall Street, the indices there too closed for the third straight day lower. All the three major indexes on Wall Street were down and about. You also saw the US 10-year Treasury yield, which is continuing to rise, and that one was trading at about 4.102% odd levels. So that is another cause of concern. And if you switch focus towards the Asian markets, those are trading quite mixed. This this morning we did see that sell-off yesterday, even in Asian markets. Today, the focus is going to be Australia's unemployment data, which is out just about now. So that is going to keep some pressure, at least for the Asian counterparts. But if you look at who's really putting in the money and who's really taking out the money, at least what we saw yesterday as well, the FIIs were clearly the net sellers, about 10,578 odd crore rupees out of equities, and most of that also coming in from HDFC Bank, because we know they have about 52% coming in from foreign institutional investors for that counter itself. So you know where exactly the pain was really coming from. And then you also did see DIIs to try and bring in some respite, but they did go on to buy about 4,006 odd crores into equities, this according to the provisional data. But we also saw the volatility index, the India VIX, jumping to about 11.11%, from 11.11 to about 15.8. So that was a good 3-4% jump that we saw just in that VIX index in a day. So lots to be wary about, we could say, in today's trading session. If you look at the FNOQs, those are also something that would give you some bit of idea of what stocks can really be looked out for. In the ban list for January 18, there are about 13 stocks in that list. Added to that list is India Energy Exchange. SAIL as well has been added back again. Retain is Aditya Birla Fashion and Retail, Ashok Leyland, Bandhan Bank, Chambal Fertilizers, Delta Corp, Hindustan Copper, and the likes. Nalco again, Polycab. Now that one's going to come out with its earnings too, but it is currently in that FNO list, so you cannot be trading in futures and options in that particular counter. Although removed from that list is Biocon as well as India Cement, Indus Towers and Piramal Enterprise. Those are out of the ban list. If you look at the option cues, now the Nifty put call ratio, that one does indicate the mood of the equity market, and we could say there is a bearish sentiment because that has dropped sharply to just about 0.7 from where it was the day earlier at 1.22 level. So below 1 PCR clearly indicates that there are more call options rather than puts, and which is what you're seeing that sentiment on the street. Let's go straight to market open there, and what we're looking on our screens. 0.5 percentage point cuts coming in there for the Nifty. Well, at least 100 points down lower, and that's what the Gift Nifty was in any case indicating that we are going to see. But you know, we are come down below that 21,500 level. So if that was a support level, clearly we've already breached that. So what could be the next levels we need to be watching out for? Let's also look at the other indices for that matter. Where is the Sensex as well as the Bank Nifty? Bank Nifty again, I think those cuts continuing for the Bank Nifty, about 1% down and about in trade. 45,500 is where we're back at the Bank Nifty. The mid cap index also trying to bring in some bit of, some relief, one would say, but in the red, of course, but not as much as cuts as what the other benchmarks are seeing. The small cap, though, they're bringing that respite or that green spurt, one would say, about 0.1% higher, the BSE small cap index. So maybe mid caps and small caps is where one would really switch focus to. But IT index also, they're taking some major cuts, 1.1% down in early opening bell, at least for the IT index. Pharma again about close to 0.5% lower, so that one also taking in, or rather, trying to bring in some bit of the positive, one would say, in this rather negative or bearish market. FMCG also taking in some cuts. But let's look at the other bigger counters that we have. Metals now seeing some respite. So clearly, yesterday when we saw China data out, we did see metals take a knock, and pretty much on your losers list were the likes of Tata Steel, JSW and the others. But today is the metal and auto pack as well, which is comfortably in the green. Just about flat trade, we would say, but at least some spurts of green in this rather sea of red that we've been looking at. Let's also look at the top losers and gainers then, and on your screen in a jiffy you will find that. Well, what's making on the list? Adani Ports, Apollo Hospitals, Ultratech Cement are your top gainers there for today. Tata Motors, L&T as well as SBI. So you have quite a good mix of auto as well as banking names there, Reliance Industries, Coal India as well as Adani. So these are the heavyweights which are going to try and bring back, or at least not let the bears have it today. But let's see who are in the laggards then and which are your top losers. On your screen you're seeing Power Grid, Asian Paints, HDFC Bank once again. So that counter clearly not getting any kind of relief, one would say. The other ones there, Bajaj Finance, IndusInd Bank, ICICI Bank. So banking names again they're in the losers list, which is why the Bank Nifty seeing those cuts of almost 1%. But let me bring on board Chandan Taparia of Motilal Oswal. Chandan, you've been waiting by, and it is quite an interesting day to be looking at trades because we're going to see a good tug of war, one would say. The bulls not really giving it easily to the bears. But what would be your strategy at this point in this current market? Do you think it's just a pullback or a proper correction we are looking at?
Good morning. Thanks for having me. We have seen a decline of around 500-600 points in last two trading sessions. 2 days back, Nifty made high of 22,124, and now we are just below 21,450 marks. So we have seen a correction of 600-700 points. One need to keep in mind that major trend is intact, but we have negated the formation of higher lows on the daily scale, and supports and resistance both are shifting lower. So earlier 21,850 used to be a barrier that acted as a hurdle. Now yesterday high was at 21,850, and now supports are shifting lower to 21,300, 21,200. So we need to look at sell on bounce stance because short-term or intraday structure has changed in the market, and we believe that till it remains below 21,600 zone, index has again potential to see more profit booking declines towards 21,300, 21,250. So the selling pressure which happened yesterday still has hangover and effect, and most of the stocks which were beaten down still have built up of short position. So expecting some bounce, and that bounce could be sold to revisit the key level of 21,300 to 21,250 marks in the Nifty index.
Right. So you're saying there could be further slide and maybe a rebound somewhere midday we could expect. But is that the strategy? And also specifically for the Bank Nifty, because that is clearly the index that is behind the carnage, one could say, at least for yesterday. But again, a gap down today as well. 2,000 points is where we saw a shave off yesterday. What do you think is the play there for at least the Bank Nifty, and what are we likely to see from here?
Yeah, so HDFC Bank is the main region which corrected by around 200 points in last two trading session, and Bank Nifty also corrected to the same tune. It was down by more than 2,000 points. It has breached an immediate key level, including 47,777, 47,000. And now till it remains below 46,250, we are expecting it to further decline to as key support of 45,250 to 45,000. So after the beaten down swings of last 2 days, recovery could be there, but it would be tough for the recovery. So those who are looking for bounce only play till 46,000, and near to 46,000 again, this banking index will find some supply at high levels.
6,000 is the level that Chandan is saying for the Bank Nifty. But let's also talk about HDFC in particular, HDFC Bank. Now, the ADR also plummeting for the second day at a trot, and we've seen some cuts, really sharp cuts there. Almost, 8,000 crore worth of like market cap is what we're saying is being shaved off. So in such a period, how should one really be looking at HDFC, and what is the play? Should one be buying, selling, holding, at least for this particular counter?
So I think one can also wait in HDFC Bank because already corrected by 200 points. However, those who are looking for investment, they can definitely go. But traders are advised to avoid. As of now, we have major support at 1460, 1450 marks. If that level is respected, then we can go for some bargain hunting the counter after the declines of around 200, 250 points recently. But those who are looking for trading point of view, let them wait and watch, because if it goes above 1540, 1550, then only the immediate structure will change or bulls again will come in the picture. So keep key levels in mind. 1460, 1450. As of now, I'm looking at a key support in HDFC Bank.
Right. So it's going to be a different trade, at least for traders. It's a different play, whereas investors now, because the stock is declining, could be an option to go ahead and buy. Let me also bring focus to another stock, Chandan, that I'd like your views on. That is IEX. Now, that is something that has gone into the FNO ban list as well. Yesterday, we saw it take cuts of about 11%, but this coming after, the minister's comment on this market coupling. But how much of that will really go on to change the things for IEX, because that is a counter that has seen quite a bit of swings on either side. So how should one be looking at this one?
Right. So structure is quite negative in the counter. Already we have seen sharp decline. Stock is making lower top, lower bottom. We have seen built up of short positions, which continuously keep the pressure in the counter. So 148 is hurdle till it remains below the same. We are expecting further decline towards 135 in IEX.
Chandan, finally, just give us quickly your top picks for today that you would recommend for our viewers.
Yeah, so in indices, we'll be slightly cautious. We are expecting sell on bounce in indices, but again, stock specific movement will be there. Two buy ideas: buy on BHEL with support of 200 for an upside move towards 220. Buy on BSoft with support of 777 for upside move towards 840. And one sell idea, that is sell on UPL, weakest counter in chemical, and this stock looks weak. All set to give the breakdown. So one can sell with a stop loss of 562, and it can drip down towards 530, 525 levels.
Very interesting picks there. BHEL a buy and UPL a sell. Thanks so much, Chandan Taparia. And also let us wish Chandan a very happy birthday that he celebrates today. Thanks so much for joining us on the show, and hope you have a great day and year ahead, Chandan.
Thank you.
Well, let's move on then and look at the other stocks that are going to be on our radar. And well, there'll be quite a few of those. HDFC Bank, of course, being one of them. We already saw the ADR, or the American Depository Receipt, plunge almost 9%. The counter also there on your screens, taking a knock, continuing. So we're going to see that counter at least under pressure. So for now, those cuts, at least we're not seeing those kind of big cuts that we saw yesterday, but we're still down and about. So maybe we're going to try and bring some bit of semblance into this counter. But the other stocks that we need to be looking out for, one is going to be NHPC. Now, this is because the government has decided to go on and sell about a 3.5% stake in the company. And this they're going to do via the OFS, or the offer for sale route, at 66 rupees per share. Now, this will be opening up today, in fact. And the OFS is going to include two components. One is the base size of just about 2.5%, and there's an option for the green shoe of about 1%. Remember, for non-retail investors, the offer will open on 18th of Jan, whereas retail investors will get to take part in this OFS on 19th January. So that will going to be interesting to watch out for. Another counter will be Persistent Systems. Now, this because there is a consideration by the board there to have a stock split, which could happen either on 19th or 20th. So that is something that will happen in the near future. So that will be an interesting counter. And staying with IT, we also had LTI Mindtree come out with its numbers yesterday, and they did register a 0.6% Q-on-Q growth in their net profits, at least, which came in at 1,169 crore rupees. whereas, of course, this being a weak quarter, and you saw that also in their operating margin performance. Revenue from operations, though, in Q3 increased by about 1.2%, coming in at 9,016 crore rupees. So persistent in going to have that stock split, where you have LTI, Mindtree in these mid-cap IT firms, we could say rather, seeing this kind of action. Another important counter is going to be from the pharma sector, and that is Sun Pharma, which could be, or which you should be keeping out on your radar, because they are going to acquire the remaining outstanding shares of Taro for about 2,891 odd crore rupees. Now remember, after this acquisition, or the complete acquisition of Taro by Sun Pharma, they are going to take Taro private post this merger is completed by the first half, they hope, of 2024. And remember, currently Sun Pharma owns about 78.48% in Taro Pharma. So that's going to be quite some of those stocks that you need to be keeping out on your radar, at least for today. But let's shift focus towards the fundamental side of things and where we stand. Of course, the markets are giving us some bit of those signals that we need to be cautious, but the economy, on the other hand, is quite resilient, one would say, and we are hearing this comment pretty much from everyone. We are right now in the midst of Davos, so the World Economic Forum that gathers in Switzerland, and this is one of the constant kind of language that we're hearing from, be it from policymakers or even industrialists, all of them who've gathered there, and that is quite something that we can cheer about, at least back home here, because if the markets are not really performing, then we need to at least have something to go on for us. And let's talk about that, and where how these economic, whether these economic macros are really something that will also push the markets further. And joining me to do that is Sandeep Bagla. He's the CEO at Trust Mutual Funds. Good morning, Sandeep, and thanks so much for speaking with us here at Money Control. Let me start off first with a broader perspective. Right now, if you look at the markets, they seem pretty volatile, and there aren't really those big triggers. Yes, we of course know we are sitting in an election year. We have the interim budget in barely weeks from now. So all of those already factored in, one would say, to how the markets are behaving. But are there any kind of headwinds or even tailwinds that could then swing the direction of the markets, according to you?
Hi, good morning, Stacy. Thank you for having me here. See, I think globally there are fairly mixed signals. The people are expecting, analysts are expecting that in the US, there could be an early rate cutting cycle because they are expecting a shallow recession. And recession normally is not great news. That means the economy is slowing down. And the central bank could be cutting rates to support the economy and the investment and consumption. So globally, I don't think that things are great from a macroeconomic perspective. The only thing which is very pushing the markets up, I think, is a global influx of liquidity which has been in the system, and it has been moving from markets to markets, and it has been pushing up prices wherever there is a potential of growth or where there is some undervaluation. And I think Indian markets are no different. We are experiencing good growth in the Indian economy compared to the global economies, and which is why our valuations are going up, and they are being spurred by the local investments who are coming due to the increase in the prices. And besides global liquidity, which is which central banks are calibrating to remove gradually, because global liquidity has long-term impact on inflation and inflationary expectations. The other important thing I would like to highlight is that because of the increasing asset prices, there is a perceptible change in the wealth effect, and that wealth effect can lead to high amount of conspicuous consumption and speculation in financial markets, and that is feeding into the markets as well. So globally, I don't think that there is any great news that we can expect.
Right. So globally, no big triggers, and the ones domestically, at least, we're kind of already factored in. But like you were talking about, so much of liquidity, and that's perhaps where we saw the valuations, at least in India, being quite, expensive, one would say. But do you think the market is yet to be overstretched in terms of these valuations? Because we've seen almost a 15% rally since October from those lows in October. So how do we really navigate this? Or how do we look at whether this inflow or outflux that we're going to see, what is really going to be the one attracting it?
So I think the volatility can be, overcome by increasing your investment horizon. So I don't think that the basic rules of fundamental investing can be wished away, and you can keep taking the valuations higher and higher just because of momentum and liquidity. I think if one wants to invest, one should invest with professional fund managers who have the ability to judge and time the markets probably. And they will also help you in terms of picking out the wheat from the chaff. So I think it is very important at this point of time to be cautious and invest with professional fund managers and really think in terms of long-term holdings. So one has to increase the long-term holding horizons because the volatility at the shorter end could be quite painful, and it could lead to disappointment in the short term. There is no real measure for us to tell how far the valuations can go. But given the economic parameters, the interest rates, the inflation, the growth, the valuations definitely are stretched. And then, which is why one has to really think slightly long term when they're investing in equities at this level.
Right. So it's a long-term play, at least if somebody is looking at equities as an investment bet. But let's also focus on the sectors that could really be helping the market overall. And let's put focus on the FMCG companies, at least, because so far they have not really had those kind of triggers, at least if it comes to their volume growth or the rest. Now, if you look at HUL, they're going to come out with its earnings tomorrow, and the profit is likely to remain quite flat. At least most of the brokerages putting that out right now. Also, the volume growth still a bit weak, and we're not seeing that pick up in a rural demand like we were anticipating. So could we see the budget really change things from here on, at least for the FMCG pack? And what would be your picks in the consumer discretionary sector overall?
Also, we won't really want to comment on individual sectors or companies. But one thing is very clear, that the capital expenditure that government has undertaken has led to some amount of pickup in investment spending. Although the capacity utilization has been quite strong, but I don't see any major capital outlay from the private sector. And when we speak to banks also, there's some amount of increase in capital expenditure and borrowings against capex. But this could be maintenance capex and not really fresh capex. So I don't think that capex cycle is going to really take off immediately. And I think government will be looking to reduce their government spending, at least in percentage terms, because there are concerns on the fiscal side as well. So I don't think government can do the heavy lifting beyond a certain point. And this budget could be a point where the markets will get to know that one cannot expect government to indefinitely start to keep spending on the capital side. Government's business is not to keep spending and keep investing in manufacturing or in industry. Government's job is primarily to govern. So the idea of government spending on the capital side was to kickstart the economy and the investment cycle, which if the private sector is not willing to take up, I think government will also have to take a step back.
Right. So maybe we might see some bit of, outlays being increased, but not as per how much we would want. Also, this is an interim budget, so perhaps not that much action that we could anticipate there. But let me finally also get your view, Sandeep, then on, which would rather be, right now what we're seeing the markets do at least is telling one to just sit back, take a look, rather reassess how one should be looking at. And in a portfolio building strategy, how would you then prepare one? Would you now look at large caps because that's where we saw the bounce back coming in, or should you still look at mid and small caps because they can still really take you forward even if we do see some major cuts like what we witnessed yesterday? Maybe the mid and small caps might have some bit of relief then.
So Stacy, I think one should have a very good asset allocation and one should stick to it and only deviate from it only on temporary basis. So I think anybody should have 50 to 60% in income-bearing assets, which will keep the portfolio value stable. And if you have 40% left, then 25% should be in large caps. See, we must understand that most of the economy, the profits are generated by large caps. Our perception about small and mid caps can change. But the reality or the ground level will not change as rapidly as the perception. So one can be taken by surprise by the rally in mid and small caps. But one can be assured that things will not change overnight and the fundamentals will take time to catch up. On purely valuation basis, the large caps look definitely far more attractive on a relative basis. I am not saying that large caps are looking attractive on an absolute basis. But on relative basis, if one has to allocate more money to equities, then the allocation should definitely be towards large caps, and large caps should perform over a period of time is this rally to continue. So I think at this point of time, if you ask me where should one allocate money, if one were to allocate money in equities, I think the lion's share should go to large caps.
It would be wise maybe to still keep or hold on if you do have some of those heavyweight names in your portfolio. Large caps in the long run should be able to deliver. At least that's Sandeep Bagla is telling our viewers. But Sandeep, finally, any kind of sectors as well as stocks? You did say that you wouldn't speak stock specific, but any kind of sectors that we need to be watching out for that could really be, a turnaround, be it IT or the banking, stocks that we saw pretty much be the underperformers last time around. Could we see some kind of change this time if you look at from the long-term perspective?
No, if there's money flow, then there will be sectoral rotation, right? On something will become relatively cheaper than others. There is some buzz that, the defense sector could open up, railways could open up. But I think one has to really wait, invest small amounts and wait for the numbers to actually come in. So I think one should have a balanced portfolio. And I do not want to overemphasize the importance of staying with experienced fund managers whom you can employ for as low as 1 or 2%. So I think one should stay with the professional fund managers.
That would be the strategy then, but if there is money coming in, rather park them in the large caps at least. Let me thank Sandeep Bagla there of Trust Mutual Fund for giving us his time this morning and helping us understand how one should really be navigating the current market scenario that we sit in. Thanks so much, Sandeep, for your time.
Thank you so much. Thank you.
Well, so with that, it's completely timed out now, but we do have a very interesting programming that you need to be looking out for. This is India's 10 trillion dream run that we're looking towards, that we are hoping and anticipating, and who's going to really take us there. We are going to be speaking with the best economists, policy makers, as well as thinkers, and all of this will be happening at Money Control's Policy Next Summit, which is happening today at the Taj Mansingh Hotel in Delhi. Tune in from 5 p.m. onwards because that's where you're going to get all that live coverage from the Policy Next Summit. Well, with that, it's a wrap, and we hope that this was informative and gave you those ideas of how you need to be navigating this market. Well, at least for now, the market's not really doing much, about 0.5% down for both the Sensex and Nifty, but we need to see whether the bulls can actually manage to scare the bears away. One would want to wait and see how that really transpires. But from the entire team that's putting this piece together, thanks so much for tuning in. Please do post your feedback for us in the comment section below and follow us on the bottom of our screens. For rest of the updates, stay tuned to moneycontrol.com as well as the Money Control app.